So we are waiting to get live. And yes, we are live. Hello, everyone. Welcome to Business Learnings. In this video, we'll talk about the inversion of yield curve. Uh, you might have heard about it. That yield curve, the inverting yield curve predicts that there is a recession coming, economic slowdown coming. And as a matter of fact, about 1 year ago, back in September 2018, the yield curve for the U.S. bond market started to show inversion, uh, which means that ideally U.S. Markets should have seen a slowdown, and they did see a slowdown. You know, in the past 60, 70 years of the history of the markets, uh, every time a yield curve has inverted, it has always been a leading indicator of a slowdown. Now, what is a yield curve? A yield curve is a relationship between uh, the price of bonds and their maturities as in the time in which they will mature. So bonds could be of, I have made a video on bonds. You can check it out, and you can understand if you um, want to get familiar with what are bonds. So bonds come with different maturities: 6 month, 1 year, 3 year, 5 year, and so on. So shorter the maturity of a bond, lesser risk you have, and that's why uh, lesser interest you earn. Longer the maturity of the bond, you earn more interest on that. So in general, higher the maturity, you should earn higher returns, right? And this is what happens in the normal conditions. But in case of a slowdown, a possible slowdown, sometimes what happens? The short-term interest rates, uh, the short-term rates, they start to rise, and the long-term rates they fall. The short-term rates, so bond yield, the yield curve initially was upward sloping, right? For smaller maturities, the interest rates, the bond yields were lesser, and for higher maturities, the bond yields simply went up higher. It was a upward sloping line. Okay. Uh, in case of an indication to the recession, the reverse happens. Long-term bond yields they fall, and short-term bond yields they stay the same, or they reduce by some extent. But long-term bond yields, this was short-term, this was long-term, and this was the line for a healthy economy. But for an unhealthy economy, this is what happens. The long-term bond yields fall and even become smaller than the short-term bond yields. Why does this happen now? So there are two reasons. First, uh, seasoned investors, they predict that economy is going to slow down, and that's why when economy is going to slow down, businesses will not make a lot of money, right? They won't make a lot of money. Therefore, their earnings, the quarterly earnings, the annual earnings that they will post, the earnings will be subdued. Earnings will be depressed. What will happen next? Companies will post depressed earnings, and share prices of the companies will fall. Okay. Now, as the share prices of the company falls, people who are invested in the equity market, they lose money. Yesterday, I had invested 100 rupees. Now the share price is only 90 rupees worth. I've lost 10 rupees. So smart investors, intelligent investors, they predict that economic slowdown is going to come. That's why they pull their money out from the equity market, where they are going to lose the money, and hand over their money to the bond market, purchase bonds from that money. Okay. Now, uh, so equity market falls down and the bond market rises up. I'll tell you why. Since these people, these investors, they are buying a lot of bonds now, the demand for bond has increased, right? And since the demand for bonds has increased, And since there are only this many amount of bonds available in the market, the prices will rise because there is a scarcity. The demand is outnumbering the supply, and therefore the prices of the bonds will rise. The price of the bond and yield are inversely related. That's why yields of the bonds fall. The yields of short-term bonds will fall, the yield of long-term bonds will fall. But the yield of short-term bonds fall lesser, and the yields of the long-term bonds fall more. Why? Because investors want to bet into something which is safer. And which is safer? Long-term bonds are considered to be more safer. Or there is one more logic, and I'll tell you what that is. Uh, in case of an economic slowdown, people and investors, analysts, they predict that the government will cut the interest rates. You can easily relate it to all the news items that you see. Uh, the Federal Reserve has been cutting the interest rates. In India, RBI has been cutting the interest rates. Why do they cut the interest rates when the economy falls? Because if they cut the interest rates, people and businesses can borrow at lesser interest rates, and if they can borrow more, there will be more business activity, and slowly the economy will start rising. That's why governments cut the interest rates, and interest rates are cut. That's why the bonds that will be issued after the interest rate cuts, they will pay lesser interest because the interest rates are cut now. So when the economy slows down, government cuts the interest rates, and government also needs money to invest into various things so that the consumption and economy could start rising again. Now, government, how does the government raise money? Government will issue bonds. Okay, these bonds will not, and government, since the interest rates are low, uh, these bonds will get lesser interest rates. Now, government issues a lot of long-term bonds to revive the economy because government is expecting the economy to, get on track in some time. It will take maybe 1 to 3 years. That's why we should better issue long-term bonds so that we don't have to pay the par value. If we issue the short-term bond, we'll have to pay the par value in 1 year, in 6 months. We do not want to do that. We are not sure if the economy will be back to normal in that much time. We'll even have that much money in the short time or not. We do not know that. That's why government simply issues long-term bonds, a lot of long-term bonds. A lot of long-term bonds in at a very smaller rates, very smaller interest rates. Why? Because the interest rates have been cut to promote the economic growth. So now we have long-term bonds issued by the government at much lower interest rates. Before the economic slowdown had started, uh, there were already a lot of long-term bonds in the market, and these long-term bonds were paying coupons, they're paying interests, which are which were more than the current interest rates, because currently the interest rates have been cut. So demand for those bonds which were issued earlier should rise, right? Demand for those bonds should rise which were issued earlier, because those are the bonds which are paying for the same amount of money, they are paying more interest rates. Compare two bonds, both are available at 100 rupees. This one pays 10 rupees interest, 10% interest. This one pays 5% interest. You will buy this one, and both of them have the same risk profile. You will obviously buy the one which pays more interest. And right, therefore, the demand for the earlier bonds, the bonds which were trading in the market before the slowdown, that rises. Okay. Now, smart investors, smart analysts have already predicted that the demand for the long-term bonds is going to rise after interest rates cut. So far we have seen that people predict that interest rates will be cut. That's why initially they buy a lot of long-term bonds. Okay. Later, when the demand for these long-term bonds rises, and since there is only so many of long-term bonds which offer higher coupon rates, the prices of these start to rise. So the prices of the bonds which were issued, long-term bonds which were issued before the economic slowdown, they start to rise. And that's why their yields further fall. So I've already explained it. To sum it all up, the yields, in the economic slowdown, during the times of economic slowdown, before economic slowdown, demand for bond rises because the money flows from equity market to the bond market. Demand for bonds rises, and that's why prices of bonds rises, and that's why the interest rates of bonds fall. Okay. The interest rates of long-term bonds fall more than the interest rate of short-term bonds because government issues more of long-term bonds, and that too at a lesser interest rates because interest rates will be cut. And this is called the inversion of the yield curve. The yield curve was initially upward sloping, and now after the rate cut, it will become downward. So this was all about the inversion of the yield curve. I hope you got it. It was a it is a I understand it's a little complicated subject, and on the internet as well. If you search it, you will not find very good explanation unless you go and spend a lot of time there. So if you still have doubts, you can post them in the comment box below. If you like the video, please press the thumbs up icon. It really motivates me to make more videos of this kind. uh, Business, economics, finance, markets, share market, etc. If you do not want to miss any knowledgeable updates, please subscribe to the channel. And thanks a lot. Thanks for watching this video. Uh, Bye.